Sentiment within the business fraternity in South Africa continues to be weak as firms battle the challenging economic environment. The SABC Business Confidence Index declined by 2.1 index points in November to 92.8 index points. Global supply chain bottlenecks and the effects of the pandemic continue to pose challenges to business. 6 sub-indices measuring business climate were negative, while 4 were positive in November. The South African Chamber of Commerce and Industry says both import as well as export volumes dipped last month. The main positive contributions came from new vehicle sales and higher share prices on the JSE. SABC says the present lockdown that came from external sources is a blow to economies emerging from the devastation of the COVID-19 pandemic. The organisation has also criticised the manner in which the initial announcement on the Omicron variant was made, saying it sparked greater concern and negatively impacted the business climate. It says these kind of announcements should be made with greater circumspection, taking into account broader implications. Consumers are showing signs of being under pressure as data points to less shopping trips in October. The retail trade sales data for October contracted by 1.3% when compared to September's 5.1% increase. When compared to the same time last year, however, retail sales trade declined to 1.8%. That is, it rose by 1.8%, and that compares to 2.1% in September. The main contributors to the annual increase of 1.8% came from retailers in pharmaceuticals and medical goods, as well as textiles and clothing. The main negative contributions were from general dealers and hardware retailers. Consumer finances have been under pressure due to high job losses associated with the effects of the pandemic. Rising inflation, pushing up the cost of living, as well as high interest rates could also deter consumers' willingness to spend. Well, to discuss the latest data, I'm joined by Elna Moolman. She's a senior economist at Standard Bank. Thanks very much for joining us, Elna. Now, retail sales were up 1.8% on a year-on-year basis for the month of October. But of course, as we indicated in the introduction, there was a decline of 1.3% when compared to September. What do you read into this latest data?
Yes, I think you have summarized it very well. In other words, I think we should see all of this still in the context of the volatility of the last few months. And I think the important reference point would be the July unrest. In other words, in July, we had that massive contraction, more than 11%. And then we had a claw back towards the previous levels. In other words, we had roughly a 5% improvement then in August and again in September. But the disappointment in the October numbers is precisely that we're not yet back at the June levels, and now we're seeing this decline. So this is telling us that 3 months after the unrest, we still haven't fully recovered and are roughly, if we look at it in volume terms, 3.3% below where we were then. And of course, this is consistent with yesterday's quarterly GDP data, which also showed a very sharp decline in total household consumption expenditure.
Given all the pressures that we outlined in the introduction around inflation, and we see that the Reserve Bank is obviously beginning to tick up interest rates as well, what's your sense of the state of the consumer, here on out, especially given that we do hear that November, for example, even though we don't have the retail sales data for that yet, we understand that people really didn't come to the party in a big way for opportunities like Black Friday, for example?
Absolutely. So our main concern is, of course, the weakness in the labour market, that sharp contraction that we had in the third quarter. And we're largely seeing that as a temporary decline. So we're assuming that it was because businesses had to close, and we're assuming that a lot of that was temporary layoffs. And then there was some job losses in the government sector, which is probably more of a timing issue in terms of temporary expanded public works program appointments. So we're hoping that that is temporary and that we ultimately see a gradual reversal and improvement there. But we are obviously concerned about it. And the biggest concern is that we're all prepared to see a significant impact of the unrest directly, immediately. But now we have to see what the longer term indirect impact is, whether we have a persistent impact on confidence, for example, so that firms perhaps don't quite employ all of those people again, etc., which would then suggest that it takes even longer to fully recover just to where we were prior to the crisis.
Yeah. Just homing in specifically on inflation, what is your sense? We know that there are some short-term pressures, even though we know that, of course, the oil price, for example, got hit a little bit, as people worried about the impact of Omicron, although the market now seems to not be so worried with talk of it being a fairly mild type of variant. But what's your thought about inflation going forward? Because obviously, if your rand is eroded in terms of its value, people are going to be less inclined to spend.
Yeah, so we think that inflation will rise quite rapidly over the next few months, and that's largely the direct effect of higher food prices and fuel prices. And obviously, we recently had quite significant increases there. So quite a significant increase in inflation, at least for the next 3 months, so taking us to about February. And then from there onwards, we expect a little bit of a moderation in the inflation numbers. So the worst period from an inflation perspective would be the next few months, with then again some improvement thereafter. But we see very divergent trends. In other words, like I've mentioned, food and fuel prices rising very rapidly, and obviously that has a very direct impact on people's spending power. Those are spending items that we can't avoid. But then we're also seeing very weak inflation in services, and that would include, for example, rental inflation. And that would obviously be a reflection of how weak consumer demand is. So the weakness that we're seeing means that you can't put up certain prices. And so you have a very wide range of inflation pressures. And we're hoping that towards the second half of next year, that will start to moderate again.
Yeah. Speaking to economists like yourselves, you're always so sober about what's going to happen, even if you're delivering bad news. But it's quite interesting of late seeing developments with the fuel price. The Twitter streets really frenzied about this. And it really gives you a sense of how concerned people are about the cost of living. How sustainable is it for us to continue experiencing the kind of fuel increases we have been experiencing? Because at the end of the day, something's got to give.
Yes, absolutely. And I would probably have to add to that. So that is the one immediate pressure point. And there our expectation would be that as global oil prices moderate from recent peaks, we should see some relief in terms of fuel prices. And if they stabilize at those levels, ultimately people's wages should catch up medium-term pressure point. But we're very concerned. I mentioned the employment situation a little bit earlier, and of course, but in the fourth quarter, we had renewed electricity load shedding, and we're very concerned about the impact of these two shocks combined. In other words, the unrest and that hit to confidence, and then the renewed load shedding. So this year's total load shedding is at least a third higher than last year, and half of this year's load shedding occurred in the fourth quarter. And that is obviously having a significant impact on confidence, production, and obviously then employment, to come back to your consumer question. So the concern would then be, we originally expected some improvement in employment starting from next year, but all of these factors may now be a setback, may mean that it takes even longer for a full employment recovery.
Elna, thank you very much for your insights there. As always, Elna Moolman, she's a senior economist at Standard Bank.